Hi, I'm Steve Clapham. Welcome to podcast episode number 5 here on the YouTube channel. In this episode, I interview Lucy Macdonald, the former CIO of Global Equities at Allianz Global Investors, where she worked for almost 20 years and managed 5 billion sterling or $8 billion of assets. She's currently an NED on the JP Morgan Global Emerging Markets Income Trust and taking care of a new puppy. Lucy has 30 years of experience in financial markets and is exactly the sort of guest we're hoping to have in the podcast. A wealth of experience, semi-retired, and not afraid to speak out. In this podcast, she explains her really unusual route to finance, her approach to running successful portfolios, how to run a team of fund managers and analysts, and how a woman copes in a man's world. If you've watched these videos before, you'll know that we are avid supporters of the Financial Times Financial Literacy and Inclusion Campaign, a charity which is designed to help young people become more financially literate. It's the most disadvantaged in society that always get taken in by financial scams. This charity has got a great objective to try and help people avoid that. And the episode is sponsored by Sentio. Sentio is a product I use myself, I really enjoy. And if you're interested in learning more about this alternative to Bloomberg, Reuters and FactSet, simply go to www.sentio.com/BTBS for behind the balance sheet. I hope you enjoy the podcast. And don't forget our disclaimer. This podcast is for your information and education and entertainment. Nothing in it should be construed as investment advice. Do your own research. I don't know your personal circumstances. I can't give you financial advice. So please do your homework. And I hope you enjoy the podcast. Lucy, hi. Thanks very much for coming on the podcast. Really nice to have you. Listen, you studied music at Bristol University. It's quite an unusual background for somebody that's been in financial markets. What made you want to come into the city?
I had no idea about the city at that age until I'd actually started playing the piano in a wine bar when I was a student. And it happened to be a wine bar where there were a lot of stockbrokers. And so through talking to some of these stockbrokers, they told me about the city. And I thought, well, that sounds quite interesting. And so when I left, it was Big Bang time. It was sort of mid-80s. Everybody was headed up towards the city. And so I sort of thought, well, that's worth looking into. And so I went up there. I got a job working for the chief economist at Barings. And that was a very interesting place to be because I had a very good vision into the different parts of the city. So, we were servicing the corporate finance and trading and the fund management. And so I could see the culture of each of those sort of activities. And I was really interested by the fund management. And I also felt the culture there was sort of more aligned to where I was coming from. And it seemed a little bit more open, slightly more diverse. I mean, not hugely, but relative to the others it was. And so I got myself qualified as an analyst. So I did that in the evenings and then persuaded somebody to give me money to manage. And once you do start managing money, then it is a bit like maths because the results are there and nobody can really argue with them. And so that's really how I got going. So it was pretty random, but I have to say at the time, I mean, there was a huge diversity of backgrounds, of academic backgrounds of people who were working in fund management then. I was working with historians and people who had studied English, as well as people who had come through from maths and economics. And it was a very, very fertile economic and intellectual debating area. So I found that a very good starting point for the profession.
And of course, Barings at that time, if I remember, it was there were some brilliant people there. I remember Andrew Parry, Malcolm Herring, some really amazing investors. So it must have been fantastic working with them.
It was a good stable. Also, I was sort of on the next desk to Crispin Odey, some of the early hedge fund managers as well, those who went off to start the Thames River, and also some of the partners who started Sloane Robinson as well. So there were some very smart people there. And that was a very good training ground. And then we had, the Barings crisis, in 1995, and that was a real learning experience from all points of view. And I had just gone back to work, having had my daughter, Eliza, and so I'd just gone back to work. I was there for a few months, and then my employer went bust, and it was a huge sort of lesson from all sorts of perspectives. And one was really that you had no idea what was going to happen next in life. I mean, nobody had forecast that, and so that was quite useful from a humility point of view of how to manage money. But there were other lessons as well, that were very useful later in my career. So, financial leverage, a bank that is over levered doesn't really take much to upend it. That was a very useful lesson, going into the financial crisis, looking to be able to avoid all the banks which were over leveraged. Importance of the financial reputation, brand. Now that's obviously important in everything, but in finance it's the most important thing, that trust element and brand. And with Barings, being able to just phone up and saying I'm from Barings, that would open the door. And then the very next day you are suddenly a global laughing stock, just absolute pariah, and the idea that anybody would give you money to manage was hilarious. So that was a very good learning point. And then I think the third one, which was from, as an investor and an analyst, was the importance of doing your own research, primary research, and not to just believe what your apparent elders and betters were telling you about a situation. And that is just incredibly important as an investor. And you start off, you do assume that other people who've been doing it a long period of time know what they're talking about, but they didn't, and our elders and betters were completely and totally blindsided by what had happened, and that was really interesting. And so, although it was a little bit shocking at the time, there were some very useful lessons that came out of it for my career after that, which I think were a help.
It's funny, isn't it? Because I remember around that time talking to a former colleague of mine who joined Barings in the Singapore office.
Yeah.
And actually, I tell a lie, I think he was in the Tokyo office. But he said it was quite commonly known that there was something bizarre happening in Singapore. And he couldn't understand why the people in London hadn't asked more questions.
Well, I think the audit were asking the questions, but the answers that they were getting back from Leeson were, I think, confused them to some extent. And he was obviously, quite good at concealing the real situation. So I think there were people halfway up who had suspicions that things weren't right, particularly obviously because the amount of cash that was going out in that direction. For the margin calls, and they had suspicions, but they didn't raise them further up because there was that, well, everything's going fine, it appears to be making a profit. It made all the profit, for that year came from Singapore. So again, there are more and more lessons there, and particularly about how the front office and back office should and should not be working together. So a lot of case history there.
It's funny, isn't it? Because we've seen so many frauds in our career that, and each time, when you look back on it, there's something slightly obvious about it. There's all the money's being made in the smallest office in the world. Why is it? And why would somebody be able to do that? And so many times we see this, and sometimes I think it's easier to spot from outside than it is from
from inside. It's very funny. So tell me, how did you end up at Allianz? What was the catalyst that made you leave Barings, or did you see all the?
Well, I was really looking to invest globally, but on a bottom-up basis. And I had shifted, from doing UK only to doing global investing. Barings was a very sort of top-down asset manager. And so it was very much, we like, Hong Kong, we'll allocate money over there and invest it there. And I felt increasingly that was the wrong way to do global investing. If you were going to have a concentrated high alpha, global portfolio, you needed to have concentrated stock picking, and therefore you needed to start with the stocks. And it was obviously the wrong way up at Barings. So I looked where else could be done. And at that time, Dresdner RCM, as it was, had just started up a global research platform. And that was looking at companies across borders, so you could compare and contrast the Nike and Adidas, and really look at them on the same basis and compare and contrast, and then build concentrated portfolios. So that seemed to me to be attractive. So that's why I went. And also there was also something called Grassroots, which was looking really sort of deep down non-financial research into products. So when the iPod and the iPad came out, then the Grassroots would really look and see what the response was to these products. And that was really very attractive as well. So it was resources, global resources, and the ability to build portfolios in that way was very attractive.
That's very interesting, the Grassroots idea, where they were looking at product design and product and market research as to how the products were being received. Now, how did that help you in investing decisions?
Well, it really, the risk in investing is you don't know what you're doing, you don't know what you're investing in, and so the more that you can reduce that thicket of ignorance, the better. And so being able to really understand what the customer responses are to the products and services of the companies that you're investing in does reduce that risk around it. Now, you can never know everything, and there has to be a point where you then stop and say, okay, well, you need to make a decision about this. And as I say, from my Barings experience, you never know what's going to happen next. So it is a question of just having enough information and understanding to take a view, and the ability to go right down on the ground. So talk to oncologists if you're investing in a cancer drug, or talk to cardiologists if you're investing in a stent. This kind of thing that you can do really does help when you are understanding what you're investing in, and getting all those different perspectives around the company from different people and stakeholders. That's very, very important. So I found it extremely useful.
When you had the resource like that, did that mean that you didn't need to use things like expert networks because you had it like your own internal expert network? Was that the way to think about it, or?
Yes, it was internal expert network, but we did use external expert networks too. And then increasingly, as time went on and then more data was available, we used data scraping, and then we would use natural language processing, anything that was going to add to your understanding of the company that you're investing in, its products and services, and its market. You would use. Why wouldn't you use it? And I think that's there's often a sort of real focus on what our internal resources are. We must only use and trust these. Well, I think you should use whatever's out there. And some of the younger analysts and people that we were taking on to the team and to the research would start with Google. They would start with Google, work backwards towards the report and accounts. They would use the report and accounts as well, but they would start in a completely different place. And that I really liked, within my investment team, is to have those, diversity of backgrounds, but also diversity of the way of thinking and the way of approaching an investment. And that, gives a much better, discussion when you're talking about, a particular investment, because you've got people coming from all different, places, and putting different emphasis on different parts of the resources that are there. But, when we think about, our careers and, the 30 years, what's happened, I think technology has been, the biggest change that's happened over that period. And, remembering going off to the Department of Trade and Industry with a huge brick of a cell phone to phone back when the trade figures came out, that's sort of, where we started. And then the internet, appeared, and suddenly there was this absolute light bulb of, this is going to be extraordinary for investors, because you're going to get access to all of this different sort of information, and then working out, as you go through, well, how are you going to deal with all this information, because not all of it is equally valuable, and these are the skills which the young people now coming through are having and using a lot more, the ability to analyze data. And to filter what's important, because for an investor, you have limited time, and you need to really be able to focus on what's important. And the more there is out there, the more difficult that task is, which is where you absolutely have to have the technology. And the other useful thing, actually, from Barings was the fact that the economics unit was also the quant unit, because the economists could add up, and therefore, they were the first people to have the computers. And therefore, I had, right from the beginning of my career, was using quant, and using quant for filtering and understanding how it could be used. And so I never had that sort of conflict that fundamental investors occasionally have with quant, because I'd always used it and always see the point of it. And that's obviously been the other big change related to technology which happened during our career, is the rise of passive, and that is still having a very big impact on the whole industry, and will continue to do so. And it's sort of different ways of getting to a very similar sort of result. Now, as an active investor, I always found it's a challenge, but it's not a challenge you mind having, because it's it really makes people focus on the active part of what you're doing. And so that always seemed to me to be quite a positive thing, because as a very active investor, because we had portfolios which were 90% active, 30 stock global portfolios, they're extremely active. So it sort of highlighted what you were doing was actually different to passive, and so there was no index hugging going on. And I think that passive trend is going to continue, because in many asset classes it produces better results and cheaper. Not all, and in global the median managers still outperform. So it still makes sense to be active in global. It makes sense to be active in emerging markets, in smaller companies, and in some times during a market, the active managers will find it better to do. But there are large swathes of equity markets where passive does as well, if not better, than active.
It's funny, you were just taking me back to my first day when I started at Horgavet, the stockbroker, and I was shown to my desk, and I turned around to my boss, Bob Cowell, who founded Mackinson Cowell, investor relations firm. I said to Bob, I said, is it possible, could I have a computer, please? And he turned around to me and he said, do you know how to work a computer? I said, yes. And he said, well, what kind of computer would you like? And when I tell that story to young people coming into the industry now, they can't conceive of a world without computers.
No,
and it's funny.
They hardly ever use the word. I don't think they do. They never call it a computer.
Yeah, no, exactly. But I remember. So you were very lucky, because you must have been quite advanced to have a computer on your desk.
Well, I was just in the right place. That's where the computers were. Although it has to be said that the some of the products which the quants were producing at those times were experimental and didn't necessarily do what they were meant to be doing. So the portfolio insurance, for instance, during the crash in 87 was not entirely successable. But that's what happens, at an early stage of an experimenting of seeing, what works, what doesn't work. And I think, watching and seeing how quant is used now, and there are still, many products which just, fail because they are based on the wrong assumptions, and so you still need a lot of sense in there as well. And even now, when computers and AI is so intelligent, it still gets things wrong, and there's still basic things where humans can add a little bit of value. And I think we're still there's some point in still having a few humans involved in the exercise of fund management, particularly while companies themselves are still managed by humans. Then and the end clients are still humans. Then you need a few people involved for that sort of trust element to work.
We always need people to work the computers. I feel so. I feel quite safe. But tell me, when you started in the economics department, has that colored your attitude to macro? What part does macro play in your thought process and in your investing process? And do you think that has been colored by your experience, good or bad, by starting out working in the economics area?
I think it really proved, to me, that rather like the Barings experience, is that nobody really knows what's going on and in the future. And so huge, incredibly complex models, econometric models are produced and fiddle around with, and they never actually tell anybody what's going to happen next. And they give a sort of an intelligent guess of how things might work. But as we all know, the world is so much more complex than any of these models, and it's involved with people, who do all sorts of bizarre things. And I think, the LTCM was a very good example, of that, where you had these brilliant people, these academics who started up their hedge fund, and they sort of failed to really put into the equation that when they themselves became, part of the reality, actually changed the dynamics of what was going on in the market, because they had this sort of incredible impact on how people would behave. And so they failed to really see that, and then they failed to see how many of the assets would actually work together, because these things change, correlations change through time. So I think that was a really interesting, example of how things can go wrong, and how even the most brilliant people have very little idea about how things are going to work in practice.
That was another issue of leverage as well, wasn't it?
Yeah.
I mean, that was a real problem with LTCM. It's funny. I mean, the fact that they use such extraordinary levels of leverage without any of these brilliant people questioning it is, I suppose, it's a classic example of groupthink, where there isn't somebody standing back and asking, well, are we doing the right thing? How did you manage to...
hubris as well.
Yeah, well, but that groupthink is very difficult in a large asset management organization, isn't it? I mean, how did you handle that sort of thing at Allianz?
Increasing diversity wherever possible, and I think that's something which has not changed enough in our times, in the city over that sort of 30-year period. That I think there's more diversity of nationality than there was when I started. When I started, it was very, very English male. There was a sort of a public school, and then there were traders, and that was it. There are a few women sort of, lurking around, some in senior positions, but not not many at all. And that's, there's different nationalities now, but then the percentage of women managing money is exactly the same as it was when I started, which is
oh, really?
extraordinary. Yeah, it hasn't changed. It hasn't changed. So all of the the efforts that have been made, that the funds globally are still it's under 10% managed by women. And
why do you think that is?
Well, there are many reasons why it is, and it's systematic that it's just the women come into the system and they start off well. So if you look at the CFA, there's quite a decent gender split there, but they get to manage some small funds, and it doesn't get much further, and that's still the case. Now, quite a lot is being done now to change it, and I think things like having a policy of more systematic hiring makes a big difference. So what we found made a difference was when you made the decisions about hiring, about promoting, and also about shifting people on. If you made those more systematic and got a broader group of people making the decisions, that shifted the needle. And so I think it goes back to the fact that decisions historically being made about who was hired, who was promoted to manage the money, who was given more money to manage. These are made by too few people, and they weren't sort of diverse people. So if you get diverse groups of people making these important decisions, then you get different outcomes. And that was a real sort of learning of the process, was that that's the only way you can shift it. Because historically, the decisions have been made about who would get a bigger fund, who would have more money coming in, were made by very, very few people, and they would give them to people that they themselves felt comfortable with, and they didn't tend to be different from themselves.
But surely this is exactly the environment in which the money talks, the performance talks. So
not absolutely, because it should do, and over time performance does make is the big determinant. But if you look at women managing funds with similar performance to men, and this, I think Citywire did this analysis, that the men would have more money to manage than the women for the same performance. Something to do with the fact also that that the men are more successful in raising the funds. So the women are equally, when you look at all the stats, the women are equally capable of producing performance, but they don't seem to raise as much money as the men do for the same performance. And that's the real, that's the real important thing. So at the end of the day, when you go out, marketing, and that's also because the gender issues there in the intermediaries as well. So who makes the decisions on who manages the money in the first place, who makes the decisions on who gives more money, and it's carried on. Anyway, I am more optimistic of a change now, because there's more focus on it, and there's more focus with the diversity project. There's more focus through the various the ESG that is part of everybody's investment process themselves. They can no longer go along to asset owners and talk about ESG if they themselves haven't got some diversity there as well. And also, if they're asking for companies to be more diverse, then if you just have a group of people coming along from a fund management company who look all exactly the same, then that doesn't really bode very well for them being able to persuade companies to be more diverse. So I think it will shift, and more systematic decision making through the promotion process, who gets the money, who gets more money to run, who is allocated money. I think it should shift, but it's taken a very, very long time.
It's interesting because I think women have got an advantage both on the sell side in broking and in fund management, and I think the women tend to be less emotional, more capable of making more rational decisions, and also have got a broader sphere of interest that they're naturally looking at as part of life. So it's always been a puzzle to me, because given the choice, I would always rather entrust a woman with my money than a man. I mean, I'm not being sexist in that sense, just from the point of view that they tend to make more rational decisions. But I don't have sufficient of a population of people that I've worked with or people that I've come into contact with in fund management, because there tends to be very, very few women. So it's difficult to form the judgment. But then, your thoughts on
the best results come from mixed teams. That's what is shown. So mixed gender, and there is not enough evidence now on any other sort of diversity that the impact on performance. But the data shows that a mixed team of gender, is makes sense and adds value, which does that sort of seems to make sense, doesn't it?
Yeah, no, and it's not just mixed in gender. I mean, it's mixed in backgrounds and experiences. Makes an enormous difference. It's been interesting moving on to training, and I've been very interested to observe how different firms work. So when I go in to do my forensic accounting course, I kick off with an exercise, and you see immediately how the business is organized and how the people work together. Because some firms, they'll start all talking as a group. Some firms, there'll be 2 or 3 people will work together. Some firms will all do it individually. And the thing I found really telling is where you've got the most senior person in the room, what they say or do, and the really effective investors I've been doing the course with, you almost don't hear them because they're pushing the younger people to speak first, and not to be scared of voicing their opinion. I think
that is an incredibly important point, and I think culturally, having an environment where, as a leader and as a boss, you just sort of take that hat off when you go into the discussions about an investment is extremely important. And being able to do that and enhance the debate and then the final decision is very important. One thing that we found very useful was something that I introduced after reading a book called How We Decide by someone called Jonah Lehrer. I think it was taken out of print, but it suggested that having voting, if you're going to be voting as a team, if you took it so it was blind, so nobody knew how anybody else was voting, you got a better outcome. And so I thought, well, let's give that a go. And that's what we did. And it really did have a huge impact. And it was because of that factor of people being aware of the boss, and how are they voting. But not just that, it was also a bit of give and take in the different votes. So, if I support you on this stock, then maybe, you can, when I bring my idea up, then you'll support me. And a lot of it is unconscious. People only know they're doing it, but they are. And so they're making these trade-offs. So they're not actually really thinking, me, myself, what do I think about this stock? And that's one way of avoiding this group think, that you were saying, is getting everybody to think, get all of that discussion and debate done, and then everyone go back and just on their own think, do I want this to buy this stock myself today? And then you get that good mix of the left, right brain, and the old, the Kahneman sort of, thinking of how the best way to decide, using your experience, but also the logic, and that I think works well. And the other thing I found was that there are some, when you're presenting a stock idea or an investment, it's easier for people to agree to the rational case. And so the logic of a case, people can agree to because they think, well, I can explain why that is. But if they're having to explain their gut, they feel much more uncomfortable about that. So that's why the individual decision making, it makes sense. And then you put that together, you collate it together, because people listen to that, and they should listen to their gut, particularly when they are experienced and their gut's been doing a lot of work over the years. Then they should listen to it. But you've got to balance that up, and you can do that if you're by yourself thinking and then deciding. It's much more difficult to do that in a group, because you're saying, well, I feel this is the right thing to do, and everybody goes, okay. Whereas the logical part's very easy to explain to everybody. So I thought that was helpful too in when you're making the decisions.
And when you introduced that kind of blind voting, how did it shift the balance? Because I imagine that previously you'd have bought something and 4 out of 5 people, or 3 out of 4 people would have been in favor of it. Did you go much closer back towards 50-50 or 60-40 when people didn't know how other people had voted? Was there more division within the team, or did it not change that much?
You got more dispersion of votes, and that was the idea. But you never sort of stopped there when you just did the vote, because if people disagreed with something, then you'd want to know why, and then that could lead back into the discussion again, because often again it's sort of it's only when you get away from something you think about it yourself and you think, understand that. I think I've got to ask that question again. I don't feel comfortable enough with it. Whereas if you're all sitting in a room together, people might not feel comfortable enough to actually say that. Now, in a good group that's been working together, a good team that's working together for a long time, one would hope that they would feel comfortable enough. But even so, there are things that people don't necessarily want to share about, things they don't understand. And so it's good to be able to get away and then think about it and then go back in again, because you'll probably find that somebody else didn't understand it either, and just didn't feel very, very brave about saying so.
No, it's always embarrassing to admit a lack of knowledge, and people find that incredibly difficult. And I mean, have you got any advice?
Too, yeah.
Have you got any sort of advice for younger people who are perhaps more junior members of a team as to how to be better at contributing to that process if you don't have a blind vote and you don't have a more understanding leader who's stepping back and not leading the debate? What would you do if you were a young analyst today to make your view heard and to play a bigger contribution in these sorts of teams?
Find a good boss, I think, is one thing which I actually say to all young people, is if just get your a good boss when you start, because that's going to make a huge difference. If you're in a situation where you have a boss who will not listen to you and just discounts what you say or sort of ridicules what you say at the worst, then if you can find yourself in a different, just find yourself somewhere else to be, frankly, because it's just too much hard work. I think you can always find your way around to find other mentors. If if your own particular boss is not particularly helpful, find other mentors around who will then intercede for you, help you, and obviously work with your other senior teammates, network, the people who I've seen really work in the organizations, network furiously with their peers, interact, ask questions, and technology really allows you to do that as well. So there's sort of the social networks that we use, internal and external, in organizations, allow you to really reach out to people, even if you've never met them. There's a certain amount of information about you on these networks, which allows someone to be happy to take a call with you. And so you should use it and just network furiously with good people, obviously.
Yeah, it's funny. people are very approachable. I just did a podcast last week with a young man in Toronto, and we were going back and forward about times, and he was very difficult on the times. And I said, well, what's the problem? And he said, oh, I won't be home from school then. And he's actually just turned 17. But it's amazing how much, how willing people are, I think, today to help and to respond. And my message to anybody is, if you're 16 and doing a podcast, don't be scared to reach out to people.
No,
one thing,
I think they are better at it. I think younger generation are pretty good about sort of reaching out.
And actually, you're unusual because you're quite good at using the networks. You're quite unusual for someone in your position, but being very visible on things like LinkedIn. I'd be interested if did you get any benefit from doing that, or was it just part of the marketing for the investment trust, or why did you do it? Because it must have taken you time, because you're good at doing it.
Well, thank you, Steve. I started doing media. It was just I was asked by Bloomberg to do it, and this was I don't know, 15 years ago, something. Very few people were doing it from at Allianz. It was quite unusual, and I thought, well, I'll give it a go. Absolutely terrifying at first. You do live television. I mean, nothing else is more frightening than that. And so I found it was quite a good skill to be able to have, because you needed to be able to answer anything. And that was quite helpful for client meetings as well, where you'd get all sorts of questions coming at you, sometimes quite bizarre, that you would need to be able to answer. So from that, I found that quite useful. And then that sort of led on to other social networks and using those.
So let's change tack, because you managed the Brunner Trust, and the Brunner Trust had, I think, 48 years, anyway, nearly 50 years of dividend growth. And I'm just interested in understanding what you think about dividends, what you think about what the challenges in running a trust where if a dividend doesn't grow, everybody's going to be very, very upset, and just dividends more generally as a component of total return. How important are they to you, and what tricks or tips do you have, can you share, in how we should look at them?
Well, as a end investor, dividends are a very nice thing to have, and certainly from the Brunner investors, they really liked having the dividend, and we made it quarterly so that it could be a real part of income. And with no income really available anywhere else from any other assets, then the income from equities became that much more important. So from that perspective, I think certainly something which is appreciated by the investors. Running the trusts with the dividend, it's not that difficult because of the level of reserves. And so the lovely thing about investment trusts is so many of them have good reserves because they've been around for such a long time. And so there was over a year and a half of reserves, which was there if it was ever needed. It wasn't needed very often, but that was there to help support that growth. Now, not all trusts have that. And so there's a little bit more pressure on the underlying portfolio to deliver in that situation. But for Brunner, it was relatively comfortable. For the other funds that I ran, most of them, dividend wasn't really an issue, because they were running a capital outperformance really was the objective. And therefore, it was all about outperforming your index, and the dividend wasn't a big part of that. I mean, the dividend, as we know, makes a big contribution to the return over a long period of time, but over the 1-3 years that we tended to be measured, the dividend was not a big part of it. And so it didn't tend to be a big focus. I think the interesting thing that happened over the time that I was managing the funds, though, was that the dividends started to come out from different places. And so, historically, it would have been very much in the more mature parts of the market and financials, utilities. You'd find decent yields. But then increasingly over time, it started, the tech sector started to produce some dividends, and Microsoft, Apple would start to produce some dividends, and the cash was there to keep that coming. And so I think that gave a different perspective to investing in some of those areas too.
Yeah, I've always been, I always thought it was quite funny. I had a client who said he liked companies that had a high dividend payout because it stopped the management doing anything too stupid,
Yeah.
which I always thought was quite an amusing thing about it. But I always get slightly concerned when people express valuations in the form of dividend yield, because that seems to me an incredibly dangerous way of looking at it. And I've always liked the idea of a company with quite a low starting dividend yield, but you had growth, because I always thought that beats something with, it doesn't always, of course, but given the choice, I would rather buy something that was growing and grew its dividend, because over time I would end up with a better income. You wrote an article for one of the financial magazines a few years ago, which talked about your investment philosophy, and it said, managing an investment portfolio requires strong, fundamentally based conviction, balanced exposure, and valuation discipline, which I thought was a great summary. But can we just talk about this? I mean, when you say strong, fundamentally based conviction, what does that mean? How does that manifest itself in practice?
Yeah, well, going back to what we're talking about, getting good research, having the resources to do that research globally, making those comparisons, and then having some non-financial on the ground, really checking that your models are based on reality. That's what I mean by the fundamentals. And so you make your decisions based on really good research, as good as you can get. So that's that part of it. Diversification, well, making sure that your portfolio is not all based on one or two macro forecasts. And you did ask earlier actually about my view about economists and coming from there, and you said that most of these models don't come out with anything that bears any resemblance to reality in the end. I think your portfolio has a lot better chance of being diversified from the corporate point of view, because companies are very different to each other. Even in the same industry, they could be very different to each other. And so you get very good diversification by putting these different companies together. And making sure when you do look at the outcome, at the performance and the attribution, that is really doing what you say it would do. So whenever we had good performance coming out of the portfolio, you'd want to see it was coming out of a number of different places. So a healthcare company over here, a Chinese internet company over there, European industrial over there, and all different sources of alpha, not all correlated. And that's really what you want to produce, because that's what you can do in equity markets. It's the wonderful thing about equities is you get that incredible diversity within of industry, but also country, but then business model and management. All of these things can really spread your risk.
I mean, you mentioned earlier, I think 30 stocks, global diversified. Why do you think more people don't adopt that more concentrated model? Because people like Terry Smith have been, demonstrated very, very good success. You've been very successful with a model like that. I mean, do you think 30 is the ideal number? And why do you think there are still portfolios around that are so so much more diverse than that? And what do you think you miss out on by having the concentration? Is there any? Do you miss out on anything?
You can manage global money in different ways. Obviously, more concentration has been coming through in the last say 10 years. So when we look at the competitors that we had, they were doing very well. A lot of them were more concentrated. So I think it was sort of going that way. Now there's still, among more quant-based funds, they tend to be a broader, more stocks. And if you are picking up a lot of smaller companies, then you can still get a decent amount of both diversification and also produce some alpha. But if you have 200 stocks that are sort of mid to large, then you're going to be closer and closer to the index, more difficult to really generate alpha out of it. So it depends what your stocks are, but that trend towards concentration seemed to be happening. Now, obviously, the more active your fund is, the better you've got to be, because you can't afford many mistakes in a portfolio that's concentrated. And so I think the trend towards quality investing, which has happened over the last few years as well, is related to that. So you've got to be absolutely sure about the quality of the businesses that you're investing in, the quality of returns, the resilience of the business model, the track record of the management and their capital allocation, all of these things. Plus now, ESG as well as integrated as part of that, looking at the quality and sustainability of the business. These things are more important, because if you only have 30 stocks in there, you can't afford one blowing up.
Tell us about your approach to ESG. Because you've got quite an interesting approach to it, and it's not one that involves labels. Can you just spend 2 minutes explaining?
Yeah, it was very fortunate to be at Allianz, for 19 years, when Allianz was really quite early with trending towards sustainability, and an early signatory of the UNPRI, and we had sustainability analysts, working with us, all of that time. And within my team, we were running the sustainability funds for all of the period that I was there. And it started off as a really quite a niche activity, should we say. And the ESG sustainability analysts were not taken particularly seriously internally, or I think for the industry as a whole. So it was a sort of interesting niche activity that no one really expected to generate too much alpha. But it was a different way of looking at things. Now, so it started off sort of in that kind of space, but as time went on, more and more these issues were coming up in the corporate the meetings that we had, and beginning to have more resonance. And I think the big watershed, I think, was the financial crisis. So through that and coming out the other side, people really began to think more seriously about some of these issues. And so from being a bit fringe, it became much more central. And for us, we had been running the sustainability funds, and we'd been able to see that there wasn't much difference at all in the outcomes of the performance between sustainability funds and our more broad funds. And so we started just to integrate these issues into the research process for all of our global funds very early on. And so because we had the experience within the team, we'd discussing the issues at the early stage when we were talking about the stocks. And so whether it was climate issues, governance, which would come into our whole quality, or whether it was more social issues, which really rose as well, more with the rise of social media and the availability of information on some of these issues was there. So it was very, very integrated into what we did. And I think the interesting thing now is the availability of data and the increasing quality of data for these factors, and having seen now that you can enhance performance, not just match performance from non-ESG portfolios, but you can enhance it through the use of these, and you can see that in how some of these factors are starting to outperform. And that's really been the big journey over the last few years, is that shift from fringe activity to really absolutely mainstream. And nobody is now saying that they're not doing it. It's just a question of how people are doing it. And now the next thing is obviously impact, and so going from not doing harm to actually doing good. And from personally now, the personal investing that I'm doing is sort of led by what can the social impact be, and can you make money out of it? So those two things now are now being, you can measure more what social impact of investments are, but it's also, you can really do good and make money, which is I think what more people want to do.
Absolutely. I mean, is your approach now, when you're managing your own money, is it very different from the way you managed other people's money when you were doing it professionally for a living?
Well, it's a lot more relaxed. and obviously, from a performance point of view, one doesn't really care about relative performance oneself.
Sure.
And as a professional investor, that's how you're measured. Is still it's a relative basis, but personally, most people don't really mind too much what the index is doing, and so it's much more absolute. So that's a big difference. And I think as we've been through a period of very, very strongly rising markets because of the free money, which is the other big change that's happened over the 30 years, is the fact that money is now practically free. Then I think there will probably be, as we get into a period where you're starting to put a price on money again, and then that will be, asset markets will be a little bit less one way. Then people will focus again, I think, a bit more on absolute. And money will be lost as well as made, and that's not been very easy to do over the last few years. Losing money, it's been shooting fish in a barrel, really. So people had to focus on a relative performance because everything's been going up. But as things are going a little bit more sideways, then the absolute suddenly becomes more important.
As you said in that article, extreme valuation plus a rising discount rate can be a dangerous combination. And yeah. I suspect that's exactly the environment that we're facing, and it will be a much more difficult navigation. Not that it's been easy in absolute terms, but it's been extraordinarily difficult in relative terms, I think, for most fund managers, because you've been through this terribly volatile and terribly difficult period with COVID. And I did a course today, a valuation course, and somebody asked me, said, well, what are we going to do, because all the valuations are stupid. And I think I've got a lot of sympathy with people that are managing money professionally, because I think it's really, really hard right now. Although the stock markets are going up and you're making money, it's hard to beat the benchmark, isn't it?
Yeah. To beat the benchmark, I think over time, for a long period, to be driver performance for quarter after quarter, year after year, which is what we do and what we've done. It's a tough thing to do, and when you look back over long periods of time, there are not that many firms and teams that have managed to do that, and certainly consistently over time. And so it is a tough thing to do. And so when you find people who do seem to be able to do it over a long period of time, you should stick with them.
No, absolutely. And it's funny how they come with very, very different recipes. They come approach it very, very differently. Lucy, you mentioned that you worked with a group of people who ended up with some of the biggest and most successful hedge funds around.
Yeah.
Did you ever think about doing long short? Is it just not appeal to you?
We had a little go at it, actually, just to experiment. And I really thought it was a very interesting experiment, because thinking about shorting was a very good sort of feeding back into your long only discussions. If you're looking at the stock, because if you're sort of screening the stocks and they come up as a short, but it happens to be one of your longs, it's a really good question about why are we thinking about this differently. But I never felt that shorting was my thing, and I always felt shorting was a shorter term activity than long investing. It's shorting is a very difficult thing to do. I mean, we say that outperforming over a long period of time is quite difficult. Well, shorting and adding value in shorting is even more difficult, particularly obviously in the markets that we've had where everything has been going up because of free money. But even without that, you've always got the events which catch people out, and you've got that sort of unlimited upside downside. And so for me, I always, having experimented with it, and obviously at times being encouraged to go and do it, I never felt that was my thing, and I was always more interested in long-term investing and thinking as far ahead as one could, being very humble about the fact that one probably didn't know what was going to happen, but investing at companies which seemed to be doing on top of their industry and producing goods and services that people liked, that seemed to work, and managing themselves in a way for the long term. And that was always what attracted me about investing, was being able to participate in some of those sort of great successes, and rather than trying to be too cute about short-term valuation. And as you said, so that for me was always the attraction, and still is.
I couldn't agree more. I mean, shorting is just so difficult, so stressful, and psychologically incredibly different. I mean, funnily enough, I've now become very friendly with some of the big US active shorting firms, and they have a very different outlook on life, and it's been fascinating because I've been involved in looking at various frauds and so on, and but very, very stressful. Yeah. Listen, thank you so much for doing this. I should have sort of said to you in advance, and I just thought about it before we came on. I should close with some questions, and I just wondered, do you have a favorite book or a favorite genre that you would recommend to people?
Well, there was a very good one written last year by someone called, I can't remember, but Smart Money Method, it was called.
Oh, don't start that. And look, if you were starting out in the industry, what book or practice or training would you recommend to somebody that was coming into the industry now? Is there?
Well, there are a couple of books that I found really, really helpful. I think the Daniel Kahneman, we talk about thinking, fast and slow, that the behavioral understanding how you yourself make a decision, how people make decisions, and how a group of people make decisions. I think that's really important as an investor. So knowing yourself, but knowing the other people you're working with and how you make those decisions, which we talked about quite a lot. I think I would definitely make sure that I really understood that. One I found really useful as well was Against the Gods by Peter Bernstein, and that's really the history of risk and humans and risk. And for investing, it's all about measuring, assessing risk, and
sure.
That I found a really useful book. So I'd recommend that as well. And he also sort of comes to the conclusion that so few will know what's going to happen, that you have to really think in scenarios about what's about the future and try and weight those scenarios sensibly. So I think that's useful as well. So those are the sort of things that I would point towards.
Brilliant. Well, that's a fantastic recommendation, and thank you so much for coming on. It's been a pleasure as ever talking to you, and thank you for all that useful and good advice.
Absolute pleasure, and good luck with it.
And playing piano in a bar, and the stockbrokers seemed to be having fun. And I thought the lessons she drew from the collapse of Barings were spot on. I really enjoyed talking to her, and I learned a lot, and I hope you did too. Before you go, do me a favour. If you've enjoyed the podcast, leave a rating or a review on Apple Podcasts. And don't forget, visit our website, behindthebalancesheet.com, where you can sign up for our free newsletter, get free training, as well as check out our fantastic investing courses. Thanks for watching.